Hi, this is Dr. K. Gurashekar, and briefly I want to introduce myself. I have three masters, M.Com.M.Phil.M.B.A, and a diploma in higher education and Ph.D. in commerce as well. I have completed 70 years of experience, and I worked with the different universities in different countries. And today, briefly, I want to discuss about a topic called capital budgeting. So I want to introduce what is called capital. So capital is the amount of money that the entrepreneur brings into the business. The capital can be brought in either in the form of money or in the form of long-term assets, such as land, building, and equipment and machineries, vehicles, and so on. A long-term asset is anything that brings the economic benefit into the business for more than a 1 year period of time. Then all such kind of assets would be called as a capital assets. So what is called a budget? A budget is a predetermined plan of the entrepreneur on how to spend his financial resources on different operations in order to raise or in order to generate the revenue for the business. What is called capital budgeting? When the business is having when the business is having a huge amount of money in order to invest in different projects, and then they need to make a decision that which project they are supposed to invest. So in that, they would make an analysis. Is it the project is worth enough to make this huge amount of investment? Is it the machinery is worth enough to buy for this amount of money? So they would be having a lot of opportunities in order to make the investment. So it is a process that the business undertakes to evaluate major investment opportunities. Assume that a business is having $500,000 to invest, but there may be many opportunities that are being available for the business. Assume that there are 5 business opportunities. So among the 5 business opportunities, which of the opportunity that the business will choose? So for example, these are the opportunities, or these are the investment that the business may have to make. Sometimes they want to buy a new machinery. Sometimes they want to expand the business in other regions. And sometimes they have to replace the machinery that has been worn out in the business. So there will be many contexts that they have to make an investment. So when they have to make an investment, how do they choose which investment is the best investment for them? So there is a process in order to identify which project is the best project for their business. So these processes are simply of identifying potential investment opportunities. As I said, when you have $500,000 to invest, what are the available opportunities around you? You have to identify them. Then the second step is you have to evaluate. Assume that you have 5 opportunities to invest. You have to evaluate each and every investment. Only then you have to take a decision which project is beneficial for the business. So I would like to focus that how do you evaluate the business opportunities? To evaluate the business opportunities, we are having techniques of capital budgeting. So we have to use certain techniques in order to measure the each and every project in terms of annual cash inflow, in terms of the length of the period of the project, in terms of total initial investment for the project or total cost of the project. So you have to consider all these factors and make a decision using the techniques which will tell us that which project would be most profitable for the business. So in these techniques of capital budgeting, we have 2 methods. One is called as a traditional method. So under the traditional method, there are 2 methods, payback period method and accounting rate of return method. So I want to give a brief explanation about payback period method. It is very easy to understand. It is very easy to calculate as well. What is called a payback period? As I'm saying in the example, if you are investing $5,000 into the business, first in your mind, the entrepreneur would always be calculating how many years does it take for me to recover this 500,000 initial investment of money. So say for example, if it takes 3 years or 4 years, then that period is called as payback period method. So there is also a formula to calculate this one. So the formula is initial investment. That is, what is the total cost of the project divided with the annual cash inflow. You are going to predict that how much this project will give us returns. That is called as a cash inflow. So say for example, this project is going to give you returns of 100,000 annually. So the formula is going to be the total cost of the project or initial investment of the project is 500,000 and annually it fetches as 100,000 as returns. So 500,000 over 100,000, that gives you 5 years. So what does it mean? So if you choose this project, it will take for the business 5 years to recover what they have invested in the business. So whatever they are going to earn after the 5 years, that is going to be their profit for the business. So this is called payback period. So what is called post-payback period? Assume that the life of this project is 10 years. But for the business, it takes 5 years to recover the money. So even after the 5 years, still this project is going to fetch you returns for another 5 years. That is called as post-payback period. Then we want to look into what is called modern or discounting method. So here we are going to introduce the concept called the time value for money. So here what is the concept of time value of money is the sum of money what you are having now is worth more than the money that you are going to receive in future. For example, assume that you are depositing into a bank $100 in the month of January. At the end of January, you are receiving $110. So you can see that end of December you are receiving $110. What is the past value or the value which had on December? That means the value of the investment is $100, but after 12 months you have received $110. So if you are thinking that I have received $110, so it is going to be like you would be like simply exaggerating the cash inflows. But what was the value of the present value of that money was $100. So in the same way in the business, year after year, you are predicting the cash flows from the project. So we have to find out what is the present value of the annual cash inflows of the future period. So in future, you are going to receive 100,000. What is the present value of that 100,000 now? At the rate of 10% rate of interest or at the rate of 10% of a discounting factor. That means you are going to discount the value of the currency as the period goes on by based on the rate of interest it fetches. Like if you receive 100,000 after 1 year at the rate of 10%, the present value of that 100,000 is $90,000 or $900 at present. So this time value of money is a very good concept to use for the capital budgeting so that you won't simply exaggerate the annual cash inflows of the future period. So you are going to determine what is the current current price or the current value of the initial investment and also the current value of the annual cash inflows of the future period. And if it is going to be more than the annual investment or cost of initial investment, then we are going to choose that product. That method is called as net present value method. So under net present value method, so we are going to calculate what is the present value of future cash inflows and what is the present value of current cash outflow. If the balancing figure is going to be a positive value, then we call it as a net present value. So if we have 5 projects and a project which shows a higher net present value, that is going to be selected for the business as the best investment proposal. So since we don't have time, I can't able to explain all of them and with the working out. So just I have given you a brief explanation. Hope you have understood this one, and thank you.